MindCypress. Education beyond boundaries.
Let's discuss about money laundering. What is money laundering? Money laundering is the process by which the criminals introduce illegally obtained funds or assets into the financial system. Overview. To hide any crime, the criminal must hide the proceeds. Anonymous. Criminals disguise the source of funds so that proceeds appear to have been obtained through legal sources. Money laundering is used to conceal illegal profits obtained from Ponzi schemes, narcotics trafficking, other criminal, fraud activity and identity theft, organized crime, weapons proliferation, smuggling, and other criminal activity. Advances in technology and the increased availability of complex financial products and transactions have led to increasingly sophisticated money laundering techniques. Financial Crimes Enforcement Network defines money laundering as money laundering is the process of making illegally gained proceeds, that is, dirty money, appear legal, that is, clean. Typically, it involves 3 steps: placement, layering, and integration. First, the illegitimate funds are furtively introduced into the legitimate financial system. Then, the money is moved around to create confusion, sometimes by wiring or transferring through numerous accounts. Finally, it is integrated into the financial system through additional transactions until the dirty money appears clean. The 3 stages of money laundering. The general objective of money laundering is to make crime proceeds appear as if they are derived from legitimate sources. Typically, money laundering operations follow 3 stages. Placement. This stage is the initial entry of criminal proceeds, which requires physically placing and depositing currency into the financial system. Most proceeds of crime or illicit activity begin with cash. During this stage, the proceeds of crime are introduced into the banking system. Example: depositing cash into a bank account in small amounts. Layering. Series of transactions or conversions designed to conceal the origin of the funds. After the proceeds have entered the banking system, the layering stage aims to move the funds through a series of transactions or transfers in an attempt to disguise the origin of the funds. Example: transfer money through a series of shell companies, different banks and accounts. Integration. Reintroduction of the proceeds into the mainstream economy to make them appear legitimate for the benefit of the criminal. During this stage, the illicit funds that have been layered through a series of transactions are used or spent by the subject further organizations. Example: to purchase a speedboat, exotic car, or vacation property. Placement. This is the first and most vulnerable stage of the money laundering process. The goal is to introduce the unlawful proceeds into the financial system without attracting the attention of the financial institution or law enforcement. Illicit money is disguised or misrepresented and placed into the financial institutions, casinos, shops, and other businesses, both local and abroad. A variety of methods can be used for this purpose, including structuring of cash deposits under the CTR reporting threshold, exchanging currency, purchase of monetary instruments, currency smuggling, and blending illicit with licit funds. Common typologies or transactions. Structuring. Breaking up large amounts of cash into smaller sums, that is, micro-deposits. Smurfing. Utilizing multiple deposit locations to avoid reporting thresholds. Currency smuggling. Transporting cash across borders to deposit in foreign financial institutions. Purchase of high-value goods, example, artwork, antiques, and precious metals and stones that can then be resold for payment by check or bank transfer. Loan repayment. Gambling casinos: buy chips, play, cash out. Currency exchange. Exchange of small denominations for larger denominations. Lending funds. Placing money in investments, such as stocks, bonds, or life insurance. Layering. This is the second stage of the money laundering process. This stage involves moving funds around the financial institution or financial system, often in a complex series of transactions, to create confusion and complicate the paper trail. This second stage involves converting the proceeds of the crime into another form and creating complex layers of financial transactions to disguise the audit trail, source, and ownership of funds. The purpose of this stage is to make it more difficult for law enforcement to detect or follow the trail of illegal proceeds. Common typologies or transactions. After inflow of funds, whether cash, wire, monetary instruments, transfer funds to and through numerous accounts in one or more financial institutions. Exchanging cash for larger denominations. Exchanging monetary instruments for larger or smaller amounts. Converting deposited cash into monetary instruments, example, bankers' drafts and money orders. Material assets bought with cash then sold, example, purchasing high-value assets and luxury items. Sending funds to different onshore and offshore bank accounts. Loans and borrowing against financial and non-financial assets. Sending wire transfers of funds from one account to another, sometimes to or from other institutions. Integration. This is the third stage and the ultimate goal of the money laundering process. Once funds are in the financial system and insulated from the layering stage, the integration stage is used to create the appearance of legality through additional transactions. The transactions further shield the criminal from a recorded connection to the funds by providing a plausible explanation for the sources of funds. Integration stage is generally difficult to identify unless there are great disparities between a person's level of employment income and source of wealth or a company's revenue, income, or assets. Common typologies or transactions. Property dealing example. The purchase and resale of commercial and residential property. Purchase investment securities. Use of front companies and front loans. Investing in businesses and luxury goods. Let's understanding terrorist financing. Terrorist financing provides financial support to terrorist organizations or individuals who encourage, plan, or support their activity. Terrorist organizations frequently raise funds from multiple sources, specifically through individuals, businesses, or through criminal activities. Financial Action Task Force, the intergovernmental body established to set standards and promote effective implementation of legal, regulatory, and operation measures for combating money laundering and terrorist financing. Further describes terrorist financing, follow the money concept as terrorists need money to carry out their atrocities, money for weapons, for supplies to make explosives, for travel. This money trail will provide valuable information to investigators and often allow them to identify those involved in the terrorist attacks. More importantly, by depriving terrorists and terrorist organizations of access to funding and the financial system, terrorist attacks could be prevented. The placement, layering, and integration stages of money laundering are usually applicable to terrorist financing activities, except in terrorist financing the subject's aim is to obfuscate the origin and final use of the funds. However, oftentimes with terrorist financing schemes, the money flows start with funds that are already in the system and could be from legitimate or illicit sources. Now, let's learn about examples of money laundering. Retail banks deposit small amounts of cash into multiple accounts and transfer funds to another account. Sales finance, buy expensive electronic goods, computers, and home appliances by entering into a contract and pay off the loan with dirty money. Personal loans obtain multiple lines of credit from one or more financial institutions and repay the loan with cash or cash equivalents. Cards obtain multiple credit cards from several financial institutions to place and layer dirty money in the financial system. Money transmitters use money transmitters to move and store proceeds of crime in a global arena. Check cashing Receive checks in small amounts that can be cashed in different locations to avoid reporting requirements. Mortgages. Make payments using dirty money from third parties in lax money laundering jurisdictions. Auto purchase vehicles with large cash down payments and soon after repay the loan with dirty money.